Hi, my name is John, and today we'll be reading Is China's 40-Year Boom Coming to an End? Editorial in Investor's Business Daily, January 24th, 2019. China. Is China's economic miracle coming to an end? It sure looks that way. Recent data and startling demographic changes portend much slower economic growth down the not-so-silken road to the future. Can China reverse the slide? Maybe not. A number of data alarms have gone off for China's economy recently. Among them, longtime China watchers note that the Middle Kingdom's economy appears to have slowed dramatically in recent years after decades of officially reported 10% per year GDP growth. Recently, China reported 2018 GDP growth of 6.6%, down from 6.9% in 2017, and its slowest pace since 1990. China's Shanghai Stock Index fell by nearly a third last year. China's exports, the longtime engine of its economy, plunged 4.4% in December. It was the biggest decline in 2 years. Nevertheless, China's trade deficit with the U.S. hit a record, a major sticking point in the trade talks with President Trump's negotiators. China. Trouble with trade. The current account, which measures global investment and capital flows, went into deficit in the first half of 2018. While expected to show a small surplus for the year, China's economy moves toward perpetual red ink as its citizens age, save less, and spend more. It will soon be competing for capital with the U.S., Japan, Europe, and much of the developing world. Perhaps worst of all, a new report suggests that for the first time in decades, China's population hasn't merely slowed its growth, it's now actually shrinking, thanks to its one-child policy. With a fast-aging population and a fertility rate well below the 2.1 children per woman required for population to remain stable, China is in a demographic death spiral. Its working-age population has shrunk for 3 straight years. To be sure, some of the factors for the recent slowing could be transient: shaky global stock markets, rising interest rates, a global growth hiccup that has caused China's exports to slow, U.S. tariffs on Chinese goods imposed by President Trump. Marx channels Keynes. Forecasters said they expect Beijing to try to shore up growth by making credit cheaper, raising government spending, and adopting measures to encourage sales of autos and consumer goods, the Associated Press noted. Good luck, since these policies are straight out of the Democratic Party's Keynesian playbook, and they won't work. As we've noted before, China's long-term prospects don't look so good. A big problem is that few economists or market analysts trust their official data anymore. As we noted, China's reported GDP growth for 2018 was 6.6%, but no one believes that's a real number. It's a political number, and even Chinese officials admit it. Chinese Premier Li Keqiang said years ago he doesn't trust GDP numbers. Instead, he relies on his own index, based on a handful of other indicators, including railroad freight tonnage, electricity output, and bank loans, among others. Then there's the debt. China has repeatedly printed money during economic weakness to shore up growth. Today, according to the Bank for International Settlement, China's total debt is now about 266% of GDP, way above both the U.S. and China. China debt bomb. As Australia's ABC News wrote this month, a 2016 International Monetary Fund report found 38 out of 43 economies whose national debt was 30% higher than its GDP experienced severe disruption in the form of financial crisis and a decline in growth. Recent trends again are ominous. UN loans were said to jump 13.5% last year, wrote economist Derek Scissors of the American Enterprise Institute earlier this week. This again outstripped nominal GDP, continuing the slow spiral into debt oblivion. Once a blessing, debt is now a liability in every sense of the word. We've been hearing for years that China will soon overtake the U.S. as the world's #1 economy. Not likely, as we've written elsewhere. And now, with China's workforce and population shrinking, its massive debt, declining productive investment, and increasing reliance on a Marxist version of Keynesian pump priming, the future is no longer bright. No catch-up in sight. The average American today produces $53,000 a year in goods and service. In China, the amount is $7,000, according to U.S. and World Bank data. That is, the average American is 7 times more productive than the average Chinese citizen, and that difference is unlikely to ever close, given what we now know of China's slowdown. As we wrote in 2014, not only has China not passed the U.S., but it's quite possible it never will. The Chinese population growth is heading for a dramatic Japanese-style collapse, which will slash economic growth dramatically in coming years. Growth has already slowed from 10% a year in the 1990s and 2000s to 7%, and it's likely to fall further from there. Chinese President Xi Jinping has restored top-down control to China and its economy, unseen since the days of Chairman Mao. Like it or not, he will bear the blame for China's stumbles going forward. He's not likely to get much help from the end of China's economic miracle. This video is a production of the School of the White Crane. Hi, my name's John Brooker. Please subscribe to this YouTube channel, and please share this video with family and friends and on social media. May God richly bless you, my beloved.